5 people in there.
Oh, that's fantastic. That's great.
All right, welcome everybody. Hope everybody's having a nice, pleasant winter evening. Tonight we've got the honor and privilege to have Peter Schultz back with us. You saw a little bit of his bio there. Peter's actually the editor of The Winning Secret, a weekly credit spread trading service. And he's also the president of the Cash Flow Heaven Publishing. So the nice thing about Peter's techniques is that he's developed them himself. They've been very successful. So we're going to let Peter have a good hour in here to show us some more of his techniques. And Peter, welcome back. Before we do, hold your questions to the end because Peter's doing off a full screen, so he can't see your questions. So hold your questions to the end. He'll be glad to stay as long as there's questions. So with that, Peter, welcome to the Candlestick Forum. We're anxious to see your techniques again.
Thank you, Steve. I always appreciate being here, and you always have the best attendees. I love the questions, and I love how sharp everybody is. And we've got a lot to cover tonight. So if you've got a pen and paper to write with, you might want to lock the door, take the phone off the hook, and you're going to learn some good things here. Appreciate the introduction, and Steve's correct there. I'm the founder of Cash Flow Heaven Publishing. We publish several different trading letters, and the one that I actually write myself and the strategy that's probably nearest and dearest to my heart is selling credit spreads. And I've been trading options since 1996, and it was a really different deal back then. The commissions were a lot higher. The bid-ask spreads were a lot higher. We've seen a lot of changes over the years, and every one of those changes has been completely to the benefit of us as traders. We've seen bid-ask spread commissions come down. We've got weekly options now. In the spring of 2012, they made it so that you could buy and sell weeklies up to 4 weeks out. That was new when weeklies were first introduced. You had to buy them the Thursday, about a week and a day before expiration. So, that's really allowed us to really place ourselves at the exact perfect point on the time decay curve. So there's some really cool things going on right now, and I think by the end of the presentation, you're just going to get kind of excited. The name of this presentation is How to Retire in 5 Years or Less on $13,000 per month tax-free. And if you're a little skeptical, if you think that's crazy, I just want you to follow along with me. We put together a really good plan for doing this. We've got a lot of people doing it right now. And the really cool thing about this is you can do this with money you're already setting aside or already have, are setting aside right now or already have in your account. So this is something really doable just for a regular person with a reasonable amount of money. And, we'll kind of take a look at what that is. But if we're going to do that, if we're going to retire on $13,000 per month tax-free, that's a pretty tall order. So exactly specifically, how do we go about that? How should we do that? Well, if you've been in to see your financial advisor or you've ever done that, sat down with your spouse and had that conversation with, well, what do we need to retire? It can be a pretty sobering conversation. You can walk out of that. Say we're talking about $13,000 per month, and if you can get along on less than that, this is going to be a lot easier for you. If you need more than that, I will actually show you a way to do that. But this $13,000 a month is actually a reasonable expectation. I'll show you why. But if you take $13,000 per month and you multiply it by 12 months in a year, it comes to $156,000 a year coming in from your investments. And I think $13,000 a month is a good number. You can live on that if you keep your trips down to Starbucks to a minimum. But that should be able to take care of your needs and get in some traveling and everything else. So at conventional, and financial advisors are pretty much tied in with conventional strategies. And I know we're all traders here. The problem with trading is, sometimes you can feel like you're going one step forward and 2 steps backwards. And I know everybody comes on and they talk about how you're going to make zillions of dollars. And for some reason, sometimes it just doesn't work out that way. So if you're doing really great with your trading, my hat's off to you. You've obviously learned some things. You have some good discipline. But you might want to actually consider this because this is a strategy that really stacks the odds in your favor, as we'll see. But let's just take a look real quickly at what the financial advisors are telling us. So if you invest your money in, say, bonds, nice safe bonds at 10-year rate, it's gone up quite a bit. It was 2% for a really long time. Right now, I think it's about 2.7%. If you want to generate $156,000 per year, you can see with the number we have down here, you're going to need $5,777,777. If you have that set aside, I congratulate you. That's fantastic, and that's wonderful. But you might, even in that situation, you might want to get a little bit higher returns on your money. If you're a little bit better at getting returns, and say you're at some higher yield dividend stocks, you're up towards the high end of those, you're in some managed limited partnerships, whatever, and you're getting 5% per year on your money, you still need $3,120,000 to generate $156,000 a year. So that just gives you an idea of what we're up against at conventional rates of return right now. So let's see if we can do a little bit better, and let's see if we can generate the income that several $1 million will produce without having several $1 million, without having anywhere close to that. And let's see if we can do that fairly reliably. So obviously we need to get better than substantially better than conventional returns, and that's what we're going to talk about. But if we're talking about your retirement money, we need to do it safely. That's super, super important. One of the things that I've learned about trading, and you have probably learned this too, is, you can be really successful and you can make a lot of money, and a few bad trades, if they're not handled correctly, can get you right back to square one. It's okay to do that a few times in the beginning. It's okay to blow up your account. We call those learning experiences. But gosh, you don't want to make a habit of it, and you sure don't want to do it with your retirement money. So we're not talking about your fast and loose trading money where you're really swinging for the fences. You've got that set aside. Maybe you're using that. Maybe you're really into the home runs, and that's great. So what this conversation is about right here tonight is how to take that amount of money that you really need for you to be there. So as you age, as you get older, you go, you know what? There's going to come a time where I either don't want to work, can't work. Maybe that time is right now, and you do not want to take big chances with this money. So we're going to take a look at some ways to really stack the deck in your favor and really give you the confidence that it's not just some expert that can do this, but you can do this. So we really need a really good plan. And in the world of investments, there is always uncertainty. So our plan has to have a high mathematical probability of success. And so this particular plan has an 85% to 90% probability of success. So in thinking about all the investing you've ever done, would that be at the high end of your probability curve? Now, the other thing to consider is what happens when a trade goes bad. So what happens at the time that a trade goes against you? And as we all know, the stock market can be a super random place. Even if we're really good at charting, even if we're really good at technical analysis, you can walk into a trade with the absolute perfect setup, be completely convinced it's going to just, it's just going to make you a ton of money and get a big surprise. That's the stock market. So what we're also going to take a look at is, okay, what happens, even if you really stack the deck in your favor, what happens when the trade goes wrong? What happens when the stock market goes against you or you get a big surprise? So our plan is based, we need to base that expectation on, what we're basing it on is the Black-Scholes pricing model, which won the Nobel Prize for Economics in 1997. Now, these three gentlemen here, Fisher Black, Myron Scholes, and Robert Merton, are responsible for putting together the options pricing model that made the modern options market possible. Now, they finished this in 1973, and it's not a coincidence that that is the year that the options exchange started under the auspices of the Chicago Board of Trade. So before then, we did not have a way to efficiently and effectively price options. And even then, for several years, I think until 1978, all you could buy and sell is calls, if you can imagine. That's, to me, the 70s are like in recent memory. So this is kind of amazing. And then like in 1978, they added puts. So all the options trading that everybody's done, this has actually been a fairly recent phenomenon. This is the last 30 or 40 years here. And like I say, there's been all these changes just in the last 10 years that have made things really great. But the cool thing about the pricing model is you can kind of see your statistical probability of winning the minute you place the trade. So that's one of the things I really like about options. Now the other thing is this strategy is based on selling options instead of buying them. So if you're an options buyer, that's fantastic. You can actually set yourself up to make a lot of money buying options. It's quite a bit more challenging because you have to be right on both price, direction, and time. Options expire worthless is almost a cliche. So if you've done much options trading, you kind of know how tricky it can be. I still buy options, but they're in very special circumstances, and I usually hedge my positions somehow or another. What I found is that selling options is kind of how people end up staying in the game. It's how you can be in the options market year in and year out, month in and month out, and still make money and still do well. And selling might not be quite as exciting if you have kind of a speculative bent, but man, it's a really, really good way to generate a lot of money and sleep at night doing it. So the reason it's important to sell options instead of buying them is you have a much, much better chance of winning. So if you've ever bought an option that expired worthless, have you ever wondered where all that money goes? And this was a huge event for me many years ago. You know, I'd had a losing streak. It seems like every time I bought an option, the option price went down before my option could become worth a lot of money. I thought, you know, there's a big, big pile of money going somewhere, and I'd like to find out where that is. And, you know, it just occurred to me finally, you know, it takes a while for some of us, that there's somebody else on the other side of that trade, and somebody was collecting all the money that I was losing. So I went back and I tallied up all the money that I'd lost trading options. You know, this is in the beginning of my career, the first few years there. And I thought to myself, my goodness, somebody is actually getting rich off of all this speculative capital that I'm throwing at the market. So here's a statistic that might kind of get your imagination going. It's estimated that just this year alone, over $1.116 trillion worth of options will be traded. So every year we seem to break records. You know, people, for a lot of reasons, they hedge positions, whatever, they love the options market, and more money is being traded every year. So over $1 trillion now for 2014. And it's also estimated that over 85% of those options will expire worthless. So if you take 85% of $1.116 trillion, it comes to approximately $949 billion worth of expiring premium this year. So ask yourself, how much of that $949 billion do you need to retire? And it's probably not a huge percentage. I mean, that is a heck of a lot of money flying back and forth. And it's kind of fun to come up with little analogies and think of how you could do this. But I mean, if you stuck out your little butterfly net and caught even a fraction of that, not have money worries as you get older, I mean, you're going to have a really, really nice cash flow, really good income stream. So how can we go about doing that? You know, there's lots of ways to sell options. Some people sell covered calls against stock that they own. That ties up a lot of capital owning that stock. I think there's more efficient ways to do it. Some people sell naked. They sell naked puts, naked calls. Personally, I think that's crazy. I think we always need a hedge because of the unpredictability of the market. Also, for those of you that are familiar with options, if you sell naked, in other words, you just sell an option without owning anything or any way to hedge against it, your broker's going to actually make you tie up a huge amount of margin. So it starts becoming not very capital efficient. So what strategy can we use? And, you know, you probably guessed it by now, we're going to use credit spreads. And credit spreads are pretty amazing. Now, if you know about them already, and if you've traded them, and if you haven't had a lot of luck trading them, I'm going to show you some ways to really, really make you fall in love with these things. And if you've never traded a credit spread before, I think you're really going to like it. So what is a credit spread? Let's figure that out first. So a credit spread, so what's cool about an option is you don't need to own it to sell it. You can sell an option. It's like going short stock. You know, you sell the option. But when you sell an option, you have an obligation, so you want to buy something to hedge it, to protect yourself. And I'll show you how that works here in a second. So a credit spread is simply selling an option and then buying another option to hedge. the option we are selling is more valuable than the one we are buying, so it creates a credit in our account that you can use to buy stuff, you can use it to reinvest, you can do whatever you want with it. But what's cool about it is that credit hits your account instantly. And then you just have to stay in the trade till expiration or until you close your spread to see how you do. So let me just show you a picture of how this works. Now, it's always fun to go into actual trades. So this is a trade that I have on right now, told all of our subscribers about, and it's Chipotle Mexican Grill, and you may have eaten at their restaurants. And as you can see, the stock is here at, so let's see, it's about $549.47. And we sold now here it is, earnings. Let me see if I can get you can see this. I think I'm going to get myself a little pencil here, or pen that I can draw. So the announced earnings right here. So this is in late January, and the stock gapped all the way up through the roof. Now, you don't need to be an expert at technical analysis to know that that's a bullish sign. Furthermore, if you just kind of draw a line here, you'll see it's been going to go down here, and we're going to sell a put spread. So with the stock up here at 549, we sold the 515 put, and we got $1.55 for that. Excuse me. And then to hedge, to protect ourselves, we bought the 510 put. So this is a $5 spread. That's the difference between these two, is $5. So we bought the 510 put for $1.05. We got a credit of 50 cents. So the most you can lose, let's just say that something crazy happened and the bottom fell out of the stock market, and CMG just fell right past our two strikes here. We would have a $5 liability, the difference between the two strikes. That's our potential loss, but we already collected 50 cents. So the most we can actually lose is $4.50. Now, we have never lost the maximum on a spread yet, and knock on wood, I hope we never do. We've got automatic orders in place to close these things early. We have a bunch of defensive strategies. There's a bunch of cool stuff we can do. But we're just talking, wildest worst case scenario. I want you to know what the absolute worst thing that could possibly happen is. So the worst thing is if this dropped through both your strikes, excuse me, and kept right on going, that's what would happen. So if we're making 50 cents, and that's divided by a potential $4.50 loss, that's an 11% return. If you take a look at when we did this, when we put this on, right here when we put on this spread, was last Wednesday. So we've just been in this thing a week. So it was, let's see, Wednesday, Thursday, Friday is 3 days. We had President's Day, so we took a day out of this week, so that's 4 plus. So we only had 7 trading days of time. An 11% return is pretty darn awesome for 11 trading days of time, but it gets better. So for those of you that are familiar with credit spreads, you know that you can do them on the downside here. You can do a put credit spread. You can also do a call credit spread. So we just go way up here. We go way up here to where we think the stock is not going to be, and that's the trick with selling spreads, is you go to a place where you think the stock is not going to go in the amount of time left. And this is where any of your technical analysis skills will really come in handy. So in this particular case, we sold the 570 call for 95 cents. We bought the 540 cents. That gave us a 55-cent credit. So let's take a look at what that comes out to. So we go, we just got 55 cents plus 50 cents. So that equals $1.05. Okay, you following me here? So keep in mind this is just for 7 trading days at a time. So $1.05, that's our premium, that's our credit. So on 10 contracts, you got a little more than $1,000 hitting your account. So $1.05 divided, and what's our margin hold? It's $5 minus $1.05. Now this is a really cool thing. in the old days, this is another thing that's improved about options trading, is in the old days, your broker would make you hold the margin for this spread and the margin for this spread. So on 5 contracts, they would hold, $10,000 back in your account. The brokers have since acknowledged that the stock cannot close both above your call spread and below your put spread at the same time. So anymore, in the last 10 years or so, with any options savvy broker, and even the other ones have come around in the last few years, they only make you hold $5 in margin, even though you have 2 spreads going on here. So we're taking in $1.05 for our 2 spreads, and we're subtracting that from $5. That's our maximum loss, and we have a maximum possible risk of $3.95. So what's really cool about spreads is the more money you take in, the more premium you collect, your risk is reduced, and so is your margin. So that's really, really cool. So $1.05 divided by $3.95 margin is 26.5% for 7 trading days of time. Now that is an awesome return, particularly with such a fantastic chance of expiring worthless. So take a look at this chart here and just think about what the chances are that this stock is going to take off so far it's going to overrun this spread, or drop so far it's going to overrun that spread. So, I just took a look at CMG Chipotle right at the close of the market, and, it was right in between our 2 spreads, and actually looking really good. So we've got just one more day on this, and hold on one second. Hello? Hello? Yeah? I thought that was the seminar call-in. It wasn't, so let me get back to it. So here's the thing, is I just took a look at Chipotle. You can actually check this out yourself. The reason that I'm showing this to you is because I wanted you to see
Peter, can you hear me? Oops, I can't hear you. Something's happened to your
Can you hear
audio.
me now?
I can hear
Can
you
you hear
now.
me now? Okay. You know what? Thank you so much, Stephen. I appreciate you cutting in. Something must have happened here. But thanks for sticking with me. I'm going to go over this chart right here because this is actually really important. what I said before is how do you know what your probability of a worthless expiration is? And, obviously we're going to take a look at the chart, just like Stephen teaches you. You take a look at the technical analysis, you see which way that stock is likely to go. The beauty of credit spreads is you don't have to be that accurate. You don't have to be right on the money. Credit spreads like horseshoes and hand grenades are good enough if you're close. But among all the other things, you want to avoid any, earnings announcements that you're selling over, anything that's going to really create a lot of volatility in that stock. The minute you put on the trade, so if you take a look back here, I don't know exactly when I cut out, but if you take a look at this trade right here, we've sold the 570, we bought the 575, we sold the 515 put, we bought the 155 put, and we've got, if this expires worthless, and I want to show you a trade that's actually on right now. So this one expires tomorrow. You can take a look, and it closed right in between our sold strikes. It closed right about here. So we've got I think a really good chance of a worthless expiration tomorrow. But when you first go in the trade and you first set it up, let me show you what that looks like. So we sold the 515 put. We bought the 510 put to hedge. If you go over here, the Thinkorswim platform, just clear this right here. If you trade with Thinkorswim, they're just the best options broker around because they have all these great tools. So if you pull up this right here and you click this little drop down, volatility, probability of being out of the money, and the delta, and that sets up all of these columns here to show those things. So this right here is your probability of being out of the money. In this case, when you're selling credit spreads, that's the probability of winning the maximum amount on that trade. So here in our case, you can see our position right here. We sold the 515, we bought the 510, and we've got a 92.18% chance of being out of the money. I love those odds. Give me around a 90% chance of winning, and I will be in that trade all day long. We come down here, we sold the 570 calls, we bought the 575 calls to hedge, and we're right at 89.93%, so right at 90% on the call spread. I love these odds. If you're talking about your retirement money, that's obviously critical. But you know what? I just ask you to just think about trading this way for your regular trading. You are going to love winning most of the time. If you're a little frustrated with your trading, if you're getting into some good technical setups and the market surprises you and they're not working out, try some of these credit spreads. You'd be shocked at, and believe it or not, it's a lot funner to win than lose, and you just kind of get used to that. It's nice. And we do have trades that go against us, but I'll show you how to handle those. They're just nothing to be afraid of. So these probabilities, 90% or whatever it is, 85%, they actually do play out in the long run. So you're going to win out of 10 trades, you're going to win on 8 or 9 of them. And they make for great odds. Plus, there are adjustments we can make to make trades better when they go against us. And that's a whole chapter. I spend a lot of time on adjustments and things that you can do to make a losing trade better. But the truth, to welcome the occasional trade that needs to be adjusted, because it says 2 things. Number 1, we're selling close enough to the underlying to have to adjust once in a while. And selling close means bringing in more money. So I like to do that. Not too close. It's kind of a fine art to figure out how far away to sell. And, a lot of the time I use 2 standard deviations as kind of a rough idea of how far away to sell. But you do already and seen what's coming up. But, we can bring in some really, really good money. Number 2, we have the means to adjust our way out of almost any situation. And that makes you feel pretty powerful and confident in what you're doing. Let me just show you one really simple adjustment. So the chart on the left here shows a credit spread, a condor, actually an iron condor. Here we sold a call spread, and on the downside we sold a put spread. And the stock is right in between the two. So we figure that this thing's going to bobble along and keep going sideways, and we're going to end up just collecting the maximum credit, and we won't have anything to worry about. Well, sometimes in the stock market, crazy things happen. So right gap down right here on the chart to the right, and then it just keeps going down, and it's threatening our bottom spread. So here's what we do. We leave this top spread, this original call spread in place, and we're going to end up collecting, keeping all of that money. We open up a new call spread that's a little closer to the underlying, and we open up a new put spread that's further away. We close this spread. Once we close that spread, there's no more risk to us. We brought in more money here. We brought in more money here. And that money, in many cases, in most cases, will more than offset your cost to close. So you'll bring in more money. In this particular case, we use the exact same expiration, so nothing's changed there, and it just buys us more time to be right. And that's when I say there's no reason to be afraid of these credit spreads if you know what you're doing and you take the appropriate action. 8 or 9 times out of 10, you're going to just sit there twiddling your thumbs, staring off into space while this thing goes to a worthless expiration. That's my favorite outcome, but I just want to let you know if a spread becomes threatened, there's a ton of things that we can do. And we always take action. With all of my subscribers, I tell them exactly what to do. I'll send out an email in the middle of the day if necessary and say, hey, this one's looking a little dicey. Here's what we want to do. And you make an adjustment with a couple of mouse clicks and you're good. So being able to adjust our positions and having the probabilities on our side is critical for the success of our plan, along with good chart reading and looking forward to the fundamentals driving the market. But what we want more than theory, we want a proven plan, a proven path to success. So has anybody actually done this with good success? So yes, we have. We've been actively, I've had directional options trading because I figured, people really need to be winning more than they're losing. And if I'm going to get people into trading, I kind of feel like I have a responsibility to do everything possible for them to make money. And I know with this strategy, they've just got the odds on their side. So has anyone else? Is there anybody else out there that's doing really well with this? And in other words, is this method duplicatable? Well, I showed my cousin Ralph out in Chicago. He's a little older than I am. He's a retired chemist. And what I've found is people that are kind of good with numbers, accountants, engineers, my cousin Ralph's a chemist. Any of those kind of folks just absolutely love this because they understand odds and probabilities. And they understand that over time, the odds and probabilities will play out in your favor. And so they do this, and I've got just a ton of these folks around the country and actually around the world now that are doing really well at this. I've got a guy named Bob Malota. He's retired. He's down in Florida. He sends me his track record every year. He made 26 trades in a row without a single loser. I just absolutely love Bob. He's fantastic. We bounce ideas off of each other. I just love these guys. But I want to give you somebody, I want to introduce you to somebody where you can go out yourself and check to see if this actually works. Now, this lady is pretty phenomenal. Maybe you've heard of her. Her name is Karen, and she started trading 100,000 of her own money using this strategy, and she even used the Thinkorswim platform to do it. She was so successful, wealthy individuals and institutions started giving her money to manage, and eventually she was managing $95 million, and over the course of $3 million using this strategy, and she's still trading today. So I want you to be able to go out and check this out on your own. I don't want this just to be a story that I'm telling you. I want you to be able to see, and these videos are so dang inspirational. It's so fun to watch her and her talking. She's actually a retired accountant, so once again, she's pretty good with numbers. She understands the odds. This gentleman that you see down here is Tom Sosnoff, and he's one of the founders of Tasty Trade, where he interviews traders and he gives strategies. So there's a YouTube video where Karen is interviewed by Tom Sosnoff, and to find that video, just Google Karen Super Trader Tasty Trade. And the first video is 24 minutes, and she talks about her making $41 million. And the second video is 51 minutes, and it talks about her making $105 million over a longer period of time. And they're both pretty darn inspirational. And one of the things I want to mention is Karen started off doing credit spreads exactly the way that we teach them. And eventually what she did when she had a large enough amount of money is she doesn't do the hedge anymore. So she sells strangles, and that's a way of selling naked options. I don't recommend that I don't know how she's able to get away with it, probably because of her account size, but it takes up too much margin to do that. But I just wanted you to know that Karen made her millions selling way out of the money options. And, she's got her own ways of doing things. But, I mean, the proof is in the pudding. She's made a ton of money for her and her investors. So Karen talks about selling about 56 days of time for optimal returns, but that was before they made the changes in 2012 to weekly options. So we can now sell less time and get bigger returns, way bigger returns than Karen's been getting. So let me just share on this time decay curve. So way out here, this is 4 months of time. This is 3 months or 90 days of time. This is 2 months. This is 2 months right here. And this is the final month, one last month. So this is 3 months of time. This is your third month. This is your fourth month. So as you can see on the time decay curve, it's fairly flat out here at 4 months. Your time decay does not happen that rapidly. It starts to steepen up a little bit in your third month. In your second month, particularly in that last week before you go front month, it gets kind of steep. Now, Karen is selling at 56 days. So she's selling right here at the very beginning of being 2 months out. So with weekly options, I've experimented with all kinds of different time frames for the amount of time you can sell your options. You can see in this last month, the time decay curve is extremely steep until at 0 at expiration day, there's no time left on that option. All the time value has evaporated. So what we do is we sell about 1.5 weeks to 2.5 weeks of time. And what we found is this gets us on a very steep portion of the time decay curve, and your options are decaying very quickly. And all that decay, all that time premium goes directly into your account. That's where it's going. That's why I see the option sellers are collecting all this time premium. It ends up in their account because that's exactly what happens. And it happens very, very quickly when you're selling 1.5 to 2.5 weeks of time. The other big advantage of selling a shorter amount of time is that you turn your money over much quicker. So, in the past here, we've talked about making a return for a 1 month time period. When you sell a month of time, you're turning your money every month. If you're selling 1.5 weeks to 2.5 weeks of time, you're really getting turning your money twice in 1 month. So whatever you're getting for that 1.5 or 2.5 weeks of time, you can actually double that for a monthly rate of return. And if you've got a smaller account or you just want to maximize your returns, getting two turns on your money per month is so much more efficient, and you'll see your account build a lot quicker. So we're taking what Karen has done as the inspiration for a new program designed to get anyone who follows it retired within 5 years. And I really think this is a possibility, a really good possibility. We just started this about 6 months ago, and it's going really, really well. These trades, so I've got 2 trades set up. I've got an aggressive credit spread trade, and I offer 2 trades per week. The second trade is a more conservative trade, and we're willing to exceed. So our typical spreads yield anywhere from 15 to 30%. As you saw in that example with CMG, we did 26.5% per month or per every 2 weeks. But what if we went for much more safety and targeted just a 10 to 20% per month return? So that's what we're kind of doing with our retirement trades, is we're making it a little bit safer. And if you want to think in terms of probability of winning or the delta, on our regular aggressive trades, we're selling about say about a 15 or a 16 delta. So that's about an 84 to an 85% probability of winning. With our retirement trades, we're trying to stick right around 90, 91%. So we're selling about a 9 to 10% delta. But what's amazing is I can still find trades out there that yield 15 to 20%. We got a really good one on the SPX retirement trade right now that if it expires worthless, it's going to yield us 22%. So I'm really excited about that. So over the past 3 months, we've actually been averaging closer to 20% on our retirement trades. But you don't get to keep all that money. Obviously, you have to factor in occasional losses. They happen. even with your very best rolling strategies, occasionally you'll take a loss. Usually it's not that big. With our win-to-loss ratio, it only takes us 2, maybe at the most 3 trades to completely overcome a loss and get back into the profit. But you have to factor those in. They'll lower your returns a little bit. Commissions you have to factor in. And the fact that we set aside a certain amount of money for buybacks and rollouts. So that money that we're setting aside isn't necessarily making us money that moment. It's kind of setting in reserve. But it's really good if you want to close a spread and roll out to another expiration. So we like to have some money set aside for that. But on the positive side, we're also averaging 2 weeks per trade instead of a month. So once again, we're turning our money over twice a month instead of once a month. So knowing that we've been getting about 20% on our retirement trades per trade, we're doing that twice a month. So that's a ridiculous, like 40% per month we're bringing in. What can you actually expect? Now, even if you set aside half of your account for rollouts and buybacks, and you kept that in cash, and you're only trading half of your account, and even factoring in the occasional loss, what can we expect? So if we're starting off with a 20% return, now in December we had a real good month. We actually averaged in our retirement trades 25%. Let's cut that down to just 20%. Do you think you could get 15% per month? Do you think you could average that? Even with as crazy and unpredictable as the stock market can be? Maybe not. Maybe that's too high. Maybe you think that's too much. I think we can do 15%, but let's cut that down to 10%. Now, I think 10% is very attainable. Even with some rough months, with some really volatile months, we've averaged very close to 10% over the last 3 years. This is per month. But you know what? Let's just get super, super conservative. Let's say you have a trouble getting this figured out. You don't get in on every winning trade. Let's say all you can do is 5% on your money per month. And so I'm not trying to be pie in the sky here. I'm not trying to create a picture that's unattainable. I want to make this really realistic. I want to make it something that you can do. Based on our experience, I know it's very realistic to expect one of these two figures right here, between 10 and 15%, if we're typically going for between 20 and 25% per trade. But let's get down here and let's just talk about 5%. What does your account look like if you can get just 5% per month? Keep in mind, we're turning our money twice per month. But if we're just talking about 5% to keep it conservative, what can we do? So getting 5% per month is still very impressive, especially when that money is compounded. It's actually pretty amazing. Compounding is just an incredible way to build wealth. If we're going to really build up that account, we want to have as much of our money working for us as possible. In other words, we want to compound our returns in a tax-free environment to get all of our money working all of the time. Plus, wouldn't it be nice to be able to take that money out tax-free when it's time? Well, of course it would. We're going to put our money in a special account that can build to infinity without having to pay any tax on the profits ever. And that special account is called a Roth IRA. Now, here's the thing about a Roth. If you get a hold of your options broker or whatever brokerage you have, and you let them know that you've had some experience trading options, you know what you're doing, and you're confident, they will let you trade IRA. So if you're not familiar with a Roth, let me just go over some of the key characteristics here. So contributions are not tax deductible like a regular IRA, but that's a very small price to pay. You can contribute $5,500 per year under the age of 50 and $6,500 a year over the age of 50. And here's what's amazing is direct contributions to a Roth IRA can be withdrawn tax-free at any time. So that money is not can. And earnings may be withdrawn tax-free and penalty-free after the age of 59 and a half. 59 and a half is not very old. The older we get, it's just amazing how things change. So, I mean, just focus on that for a minute. Focus on that idea. That means no matter how much money you build up in this account, you can withdraw it tax-free and penalty-free after the age of 59 and a half. Now, there's a bunch of other really, really cool advantages to a Roth. One of them is it doesn't change your adjusted gross income. So it does not bump you. It does not increase your tax bracket. So you could be taking out, $5,000 a month, $10,000 a month, $13,000 a month. It doesn't increase your tax bracket. And it also doesn't affect your Social Security benefits. It's just an amazing, amazing program. It's one of the things Congress did to us that I can actually say is a super big benefit. Now, there is some restrictions. So if you're a single filer, you can make up to $110,000 to qualify for a full contribution, and a joint filer up to $173,000. The good news is if you're making a lot more money than that, you probably got a lot of extra money to invest, so that's good. But you can check out the details, further details, but I just want to get you familiar with this because it is a heck of a great program. And if you have an account that you really are confident you can build up some money in, I'm convinced a Roth is absolutely the way to go. So the amazing thing about a Roth is that you can build up any amount of wealth in the account you want. And as long as the distributions are taken after the age of 59 and a half, the money you take out is completely tax-free. So if we're averaging just 5%, now keep in mind we've been doing better, and I believe it's absolutely possible to do better, and we've proven that. But if we're averaging just a 5% monthly return, and we are only using the money we can put in a Roth, what kind of an account can we build up? Maximum we can put in a Roth is $6,500 per year. So if we put that amount into the account every year for 5 years, no more than that, just $6,500, and got a 5% per month trading this strategy, how much would we end up with? You can figure this out yourself on a compound interest calculator, but it's pretty fun to see a picture of what it does. So you're going to start out here, and after just 1 year, you've got $11,674. Your account's almost doubled, and you're bringing in $584 a month. After your second year, you've got an amazing $32,000 in the account. You're getting $1,632 a month. This amount right here, retiree's life, and this is after your second year. On year 3, you got $70,000 built up into your account, and you're bringing in $3,500 per month. At year 4, you've got almost $138,000 in the account, and you're bringing in right close to $6,900 per month. This is huge. If you're bringing in this amount of money in retirement, you're automatically ahead of about 99% of the retirees out there. In year 5 is where it really gets interesting. You've built up your account to $259,000, and you're bringing in just a hair under $13,000 per month. So this is where we come up with this figure, and this is at 5% compounded monthly. We're not talking about 20% or 15% or 10%. We're not talking about getting this 5% twice a month because we're selling a week and a half to 2 weeks at a time. We're talking about, in my mind, the most conservative scenario, and that's just bringing in 5% per month. This is what your account builds to in 5 years. You ought to find this pretty dang inspiring, and most of us can find somewhere out there $6,500 in a year to put into a Roth. So, if you want to get your imagination going, and usually when I see these kind of presentations, I see these kind of numbers, I go, okay, well, that's really cool. That's really interesting. But you don't have to take your money out. The government doesn't make you take the money out. You can build it up for as long as you want. So what does year 6 look like? What does year 7 look like? And if you're curious about that, I just thought I'd put together a really quick graph and show you. It gets pretty wild, and you can see where this curve starts just going up exponentially. So, you can take a quick glance at these if you want. At the end of year 6, you got $447,000. You're bringing in $22,000 a month. It gets really, really crazy. You got a $78,000 a month income here, a $141,000 income in year 9. It gets outrageous. Now, let's get back to let's just take a look at this. I realize we don't live in the calculator world. We live in the real world. And if that's what you're thinking right now, you're exactly right. This is trading. There's no way to get exactly 5% every month. In the real world, we won't get exactly 5%. Sometimes there's going to be setbacks. That's how the stock market works. And sometimes we'll do better. And I can just tell you from experience, track record is available publicly. You can go in and you can see every trade that we've made, and you can see exactly how we've done. You can see the winners, you can see the losers, and you can see our averages. And our averages are well above 5%. So I can say, based on previous experiences, that chances are, it's no guarantee, but chances are we're going to average more than that. But you've seen what just 5% per month can do. I think this is a really viable method. I think this actually works. And the point is, the plan looks like it will work, and it's working right now. And it's not just working for me, it's working for our subscribers, and I think it'll work for you. And it's not because we're geniuses, it's because you're trading a strategy that automatically stacks the deck in your favor with the odds. And I think that's what most of us need. We need an edge. All of the things being equal, we need to win most of the time. So I opened a Roth IRA at Thinkorswim, and if you let them know you have options experience, they'll let you sell. And if you decide to come along and do this with me, I'll even set you up with an account at Thinkorswim with the inside track to discounted commissions, and that gives you a huge advantage. So we're doing 2 trades per week, and they come out on Tuesday evening, so you can get them by Wednesday morning. You can be all ready to enter your trades. And the first trade is our usual more aggressive, higher return credit spread. This is where we're trying to, shoot for around 25%. But our second trade is a Roth retirement trade. More return, but safer. We'll be shooting for a 15 to 20% or better return with a 90% plus probability of winning. And the 2 trades can be traded in 2 separate accounts. Some people set up separate accounts for these, a Roth account and a regular account. And as you've seen, the build up over time can be pretty amazing. So I hope you got something, you learned something out of this. I can give you a lot more details on how to trade these and exactly what to do. But just in short, this is a trade you don't want to miss. I'm not here to replace any other trading that you're already doing. If you've got some strategies that you really like, by all means, keep doing them. Take and set aside some money to do this strategy. So refreshing for you to have a strategy that just wins most of the time, and you'll get used to that. It really takes away a lot of the stress in trading. It just gives you the confidence when you go into a trade, you know you're probably going to win, and you know if one of your spreads gets threatened, you can do something about it. So it's super important to me that you're successful with this, so I want to make sure you've got everything that you need. And I put together a really, really good program that just answers all your questions. It's really, really complete. So to make sure you have a really good understanding of how this strategy works, the first thing we put together is a complete video presentation called How to Trade Credit Spreads for Fun and Profit. And it shows you step by step why they work so well and how they can work for you. So if you're a newbie to credit spreads, you kind of like the concept, you like the probabilities, but you just can't wrap your head around how they work, this presentation will just really get you from where you are now to where you need to be, where you have a really good understanding of the strategy. And then after that, we can get into the really good stuff. So I put together this huge comprehensive package. It's called The Winning Secret. And you'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting close to your spread, how many spreads to have on at one time, plus a big section on adjustments, everything you need to trade this strategy with confidence. And just to give you a really quick synopsis, it includes a 161-page download, charts, pictures, everything you need to start trading profitably and stay that way. You get a 15-chapter video series. You get 14 separate audio files you can download to your iPod. You can listen to them in your car when you're on the run. You're going to gain access to our archived webinars, and you'll have access to all of our new webinars for life as an owner of the package. Plus, you'll get 3 videos that show you how to set up automatic orders with our favorite broker, and that's Thinkorswim, to automate your trades. And these videos will show you how to automate your trades so you don't have to consistently and constantly monitor them, providing peace of mind knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. So off strategy, Thinkorswim's got some really cool software. You can enter really great orders to close a spread at the exact right time so you never get blindsided and you don't feel like you have to sit there and watch your computer all the time. It's pretty nice. And then the actual subscription is you get 2 high probability trades every week, and I'll show you exactly where to sell your credit spreads, exactly how to sell them, for maximum gains with minimum risk. If a trade does need to be adjusted, I'll send you out an email right away and let you know. Really comprehensive. It's $97 a month. You'll probably bring in way more than that on your first trade. I didn't want this to be a burden or be too high priced. For what you get, for the track record, for the win ratio, it's an incredible value, and I want you to have it. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. This is one of the most popular courses we've ever put together. People are crazy about the weeklies right now. The weeklies have changed the entire game of options trading. It really allows you to bring in money faster. It gets you on the right point in the time decay curve to really increase your odds. And we get more requests for this package than anything we've ever put together, and I'm going to include this as a bonus going for you possible. You'll also get a special link to open an account at the best broker in existence for this strategy, and I believe that's Thinkorswim. And once the account's open, I'll put you in touch with our special contact at TD Ameritrade to get you special commission rates set up just for this program. So at Thinkorswim, they know that credit spread traders trade a lot more contracts than the average trader. On a regular spread, you've got 2 legs. On a Condor, you've got 4 legs. You're trading a lot of credit or a lot of contract. You, as a customer, they like that you're coming from us. So they're going to give you, I've gotten feedback from our customers, our subscribers, and they get way, way better commissions than what's advertised on the website. So that's something we'll hook you up with. I'm really excited to be able to offer that. So I want you to come on board so we can trade this plan together. And I want you to invest what you can to start off with and prove to yourself how well this works. The proof is in the pudding. It's one thing to hear about something at a webinar, and it's another thing to actually do it and have the money hit your account and see that it works. And I want you to watch your account build. And so to get everything we talked about and to put your feet firmly on the path to a more generous and secure retirement, go to this link right here, and maybe Becky can put it up for you, but if you want to just write it down and go to it on your computer, it's betterthancashflow.com. And I've got a special package here where I put absolutely everything together for you. You get your first month of the subscription. The package, I've sold it at live events for $1,250. People absolutely love it. I still get emails from people that are supporting themselves using this strategy. On the website, we've got it for $397. And I'm going to package both the subscription and the education together for you for a really, really attractive package deal. So go ahead to betterthancashflow.com. We've got a few minutes left. I actually haven't been able to look at your questions, so any comments that you've been making, if you've been talking about, what a bad guy I am or whatever, I haven't been able to see that. But I want to switch over right now to your questions, and I want to get those answered. So if you've got questions, want you to have a chance to get them answered. And let's just take a look and see what we got here. Okay. Let me just take a look. I gotta get rid of this pen here for starters. Hold on a second. Alrighty. Let's get back to the questions. Okay, here we go. Oh, is there a phone contact number to talk to you? Yeah, thank you for asking, Don. It's 877, so it's a toll-free number, 507-7272. So that's 877-507-7272. And by the way, I've got really good gals here that answer the phone. These gals know this strategy forwards and backwards. In fact, Alicia, who you can probably get a hold of if you call during the middle of the day, she's actually got an advanced degree in finance. She graduated at the top of her class. She's an absolute genius with numbers. She is so fantastic. So Alicia's really, really good. So anyway, let me get back here. Let's see. Are we getting a copy? I think that's up to Steve. I think Steve's going to send out a copy tomorrow. John K. can't contribute to a Roth if you're retired and not working. A lot of these Roth questions, just check with your tax preparer. Okay, I need questions. Everybody's making comments and talking to each other. Yeah, Don, thank you for putting that in there. 877-507-7272. What about Canadians? I think you guys go to TD something or other up in Canada, and they will hook you up with a Thinkorswim account. It's not Ameritrade up in Canada. It's like TD Wealth or something like that. Is it possible to trade this strategy outside the U.S.? Yes, it is. What's your average amount at risk per trade? Well, if we just as a general idea, if you take in a $1 credit on a $5 spread, you're going to be risking $4. So on 10 contracts, that's $4,000. Or excuse me, it's $4. So on 100 shares, that's 400. TD Waterhouse, thank you very much. Do you trade monthlies or weeklies or only weeklies? Well, the monthlies are just the third Friday of the month. So yeah, I've often traded into that expiration. I also do the weeklies. To use the delta of just a short leg, or how do you combine the deltas of the legs of a spread? I always use the delta of the short leg because that's the one that you're concerned about. That's the one that you're concerned about getting overrun. Can we start with a very small account of 2,000? Yes, you can, but try not to tie up too much and just do 1 or 2 contracts at a time until you built up your account. Why not use debit spreads? Debit spreads are directional, and that's a whole different ball game. Once again, you have to be right on direction and timing. Is there enough liquidity in the market to achieve the monthly income figures you described? Absolutely. A lot of what we trade, first of all, we only trade stocks with a ton of liquidity because I want that really narrow bid-ask spread. That's super, super important. So, and a lot of the times we're trading the SPX or the RUT. I mean, you can have almost an unlimited amount of money and trade those markets. It's just hard to move them. They're super, super deep. Terry M says, do you really place iron condors with no idea where the market might go? Of course not. You look at the chart, you look at the fundamentals, you don't trade over an earnings announcement. There's a heck of a lot of things that you can do to increase the odds of your iron condors. Do you use ETFs and avoid earnings and gaps? Yes, I avoid earnings and gaps, although gaps actually can be kind of cool because they increase your volatility. Trade in the opposite direction of the gap and you can usually do pretty well. And obviously, on your call spreads, you're going to be trading above resistance. On your put spreads, you're going to be trading below support. It says getting some error with the web page requires security code. You know what? That deal should be good in there at the promo price. And if it isn't, call our offices tomorrow or send Alicia an email. And you can email customer service at cashflowheaven.com, and I will absolutely honor this special. Absolutely. Just tell them that you're with Stephen Bigelow. That's really important to tell them that you're with his group, and tell them that you want to take advantage of the special. You can ask Alicia any questions that you want, and I'm actually really looking forward to having you on board. How do you select your picks? I go through a really big process. The delta is that's one of the things that I show you, but I take a look at what's coming up fundamentally on the stock. I look at the probabilities, and frankly, I do a lot of technical analysis to try and determine where that stock is likely to be in the next week and a half to 2 weeks. Seems like everybody is selling these credit spread courses and doing credit spreads. There's a reason for that. Your win ratio just goes way through the roof. And by the way, everybody has a different way of trading credit spreads. I really feel like what we do is we get on that sweet spot where you get the maximum amount of return for the lowest amount of risk. Anthony says, can you use inflated implied volatility? I'm going to get back to your question because that looks like a good one. Inflated implied volatility before EPS release to set the trade beyond that range. You can. I don't like to trade over earnings. A lot of the time after earnings, you'll get a great big gap one way or the other. And so you can take advantage of really big inflated implied volatilities without having to trade over the earnings announcement. I mean, a fantastic example was Apple just a couple of weeks ago. They announced earnings. The stock dropped through the floor. Volatility went through the roof, and you could sell way out of the money and collect some super fat premium for just about a week and a half. And all the mystery's gone out. The next day, implied volatility is really high. Within a day or two, all that implied volatility is leaked out of the options, and you're already making money. So anyway, yeah, I absolutely look at implied volatility. JD Mark says, so you pick all the trades? Absolutely, yes, I do, and I give you my logic, all my reasoning, exactly why those trades are made and why we're picking them. You may have have to copy and paste the link. So that's what Steven says. Do candlestick signals play a role in your program? You know, that's a good question, Jay, and it's particularly relevant because we're on Stephen Bigelow's site with candlesticks. And yeah, I trade candlesticks, and every chart that I show you, when I show you a new trade that we're getting into, it's actually in the candlestick format. So if you're a candlestick trader, you are going to like trading credit spreads with me because it's going to be really, really familiar to you. Are there any supporting webinars? Yes, there are. I've got a ton of webinars in the program that you can watch. What percent of your portfolio is in each trade? You know, maybe 10% max. We're usually in and out of the trades quick enough in a week and a half or so. You can have 4 or 5 trades going on and still keep half your account in cash. Actually, Nick Meta says, how is high volatility environment handled? Spreads usually fail in a high VIX environment. I love high VIX environments because what you'll find about the VIX, if you pull up a chart of the VIX, you'll see that it can spike really, really high, but it never stays up there very long. So if you sell in a high VIX environment, chances are really good things are going to get flat really quick. This only works in certain market? No, it works in all markets. You just have to vary the width of your spreads and determine how wide you're going to sell. And like if we have a really big bull market like we had for this past several months or the past several months, you sell a lot of put spreads. You sell in the opposite direction that the market is going. So we're not always doing condors. We'll often sell one side of the market or the other. Says last year everybody sold naked put courses, hate naked puts, hate naked options. You know, very few of us look good enough after the age of about 25 to be wandering down Wall Street naked. I don't recommend it. You can lose more than your dignity. Just be hedged. You know, it doesn't cost that much to buy that hedging put or call, and you'll really be glad you did. Yeah, Tesla today totally took off. You know what? You guys have a ton of good questions. I want to answer every single one of them. I can't. We're kind of winding down here. I'm just going to take a couple of more, and then we're going to get going. But go to that website, betterthancashflow.com. Take advantage of, the 97 per month, and I've got a reduced price there. Greg M. asks, does that include the DVDs and audio files? Yes, absolutely. The whole package does. It's, like I say, it's $297, almost $400 on the website. Another $97 a month for the service. That's about $500, and you're going to get a really nice discount at the page when you go to it. And this is just for Steve Bigelow people. This isn't available to anybody else. That's why we have that unique URL. Do you get the same benefits through TD Waterhouse from Canada? Yes, you do. I've got a ton of Canadians on the program. Love the Canadians, and they love the Thinkorswim platform. We are going to send Cecil White asks, are we going to get a replay? Yes, we absolutely are. Betterthancashflow.com. Once again, if you cannot get to the site, if there's some reason that it's not working, go ahead and call our offices tomorrow or email us. The phone number is 877-507-7878. You can also email us at customerservice@cashflowheaven.com. So, and the link's going to be emailed to you tomorrow. Once again, Alicia's answering the phones. I've also got Shannon. They're both really, really good. So, so it says, Larry K. are the bonuses you mentioned the Aspire to Retirement Special $297? That's exactly what it is. Yeah, it's a big, big discount. You're getting a lot here. Plus your first month of the subscription. And my feeling on these subscriptions and this education is that your education should absolutely pay for your subscription plus leave you a lot left over. So like I say, on the first trade, you're going to bring that in, and we've got eight different trades we do per month. And I think you're going to like this. So listen, I want to thank you for your attention. I want to thank you for being here. There's nothing more fun than going over these trading strategies. This is one that I absolutely love because you just tend to win most of the time. So I appreciate you being here. I want to answer some more questions. Go ahead and email us or call our offices tomorrow if you can't get in tonight. If you can get in tonight, just go ahead and do it. And you can access the website immediately and you can see what we've got going on right now. So we have a lot of good things. We're making a lot of money, and I'm going to get in there and I'm going to try and answer some more of your private messages. And I just really hope you come on board with us. I'll really look forward to it. It's a lot more fun to make money together than apart. So hopefully we'll see you inside the site. And I want to thank Stephen again for having me. I really appreciate you guys. Be well, trade well, and hopefully we'll see you soon. Take care.
Peter, thank you very much. Very good information. So everybody, if you've got a system that works, go ahead and take advantage of it. So Peter's been doing very well through the years. And as you can see, it's just like what I try to convey from candlesticks. It's just common sense. When you put all the probabilities in your favor, you're going to make money. So with that, everybody run out in the snow, and we'll see you in the chat rooms tomorrow. Peter, again, thank you. Very good information.
You're sure welcome, Stephen. Thanks for having me.